Hello traders, thank you so very much for spending your time with me today. We are going to be starting a series on indicators. Today we are going to be covering the RSI, or Relative Strength Index. Many of you have provided questions to me about my usage of the RSI, so I do want to give this information to you while I start this series. We'll also be going over indicators such as the MACD, the stochastics, Fibonacci's as we continue along here. But let's start with the RSI. Oh, by the way, I also want to mention to you that at the end of this video, I'll be also sharing with you the 3 biggest mistakes of using indicators, so please stay tuned for that. So the Relative Strength Indicator is a momentum oscillator. What it does, it measures the speed and the change of the price action over a particular period of time. And it also indicates whether the market is oversold or overbought. Now, this was introduced by J. Wells Wilder back in 1978. I like to investigate and know the history of what I'm relying on when I do my charting and such. So I'm interested in finding more information about where indicators are coming from, when were they developed. But anyway, so his indicator, the RSI, has specific parameters in that it is measured at a 14-period basis. 70 meaning overbought, and below 30 is oversold. Now those are his standards, and those are the ones that I use because I figure he is the expert, and so I will rely on those. Now you can certainly make those adjustments as you use this, depending on the time frame possibly that you're using it on. I use the RSI pretty much on all time frames. I pay a little more attention to it depending on the price action and whether I'm just scalping or I'm in it for a longer period of time. So I want to show this to you today, and I want to show it to you in different time frames as how you can use it. It will show you different trend reversals, trend weakness, momentum, and such. So let's get into this a little bit. In front of you here, this is the S&P on the futures index, or the ES futures index. This is on a 15-minute chart. So let's talk about this as far as an oversold. You can see below here, this is your RSI indicator. Over 70 overbought, less than 30 is oversold. So here we are. We're looking at this price action, and look at the strong momentum and trend to the upside here. Now, there are a few different things that I also look at in correlation with my RSI. I certainly don't depend on that indicator just by itself. Here we have a nice pattern. This is a falling 3 pattern, which is a continuation pattern. That was gave me a lot of information here on the 15-minute chart. At that point in time, now the RSI was just hovering at 70, but then it continued up above 70. Also, besides the falling 3 price action pattern, we also had above my EMA, my exponential moving average, which I have here on the chart. I'm also always looking at that. That would give me a good indication to go long on there and look at the strong momentum to the upside. And then with the RSI dropped down considerably, as you can see, bounced back up. Now, when it came back up, it couldn't even hit that 70 point. So there was became a lot of very weak in the RSI. And you can see by the price action up at the top here of the price action, we had, the strong move up. It dipped back down a little, still above the EMA. But when it came back up, it couldn't even hit the top of that high. So we had a little trend to the downside here that was beginning. You didn't even have a wick that came up and tested that. So right away we knew that there was weakness to this price action, and sure enough, then it came back down. So that's how you want to look at when you're working at an overbought point. You want to also always look at your other indicators, your patterns of your price. So really a good strategy overall. And I want to also point out, look at your RSI, how the trend on the RSI, you could put a trend line here that would match to your price action here. Now that's kind of what you want to see when you're looking at an RSI also. But then you have divergence, and we're going to get to that in just a minute. But now let's look at something when you're looking at an oversold level, and that would be, this is the YM, or the Dow, and this is on an hourly chart. So I want to point out how to look at an oversold signal. here we have, like I said, it can be oversold or overbought for an extended period of time. You don't want to just jump in right when you get the indication that, let's say, fell below 30 and then it came up to the 30 line. No, you don't want to jump in there, because look at the price action. Definitely in a trend down. Very, very weak. A lot of consolidation. Not much activity happening there until we get to this point in time. At that point, it came up. See right here, came up above 30, but look, it was still well below my exponential moving average, so I would not take any action on that. It came back up. It was well below the 50. I don't think I've mentioned that to you yet. Also, on the RSI, I always indicate the 50 or the mean, because it oftentimes will test that level. It'll come back up to the 50 and then it'll reverse and go back down, or it'll come down to the 50 and then that'll be a bounce and it'll go back up. So I'm always well aware how it's acting around that 50 point. So here we have, then it came back up. It did go above the 50. At that point in time, it also went up above my exponential moving average, and that would have been a point that I would go long on this one. And then it continued up and then became well overbought, and you can see then the trend reversed. So it's really interesting to see how that reacts to your price action and how you can play that, as long as you're using it in correlation with some other indicators and such that you become familiar with. Okay, so now let's talk about divergence. First, we're going to take a look at bearish divergence, as you'll see in the graph here on the screen. Bearish divergence is when the price is making higher highs, but the RSI is made lower lows. Now you see here, correlating here on these trend lines that I have both on the price chart here, moving up. And this is on a 4-hour chart, by the way. This is a 4-hour chart this is on oil. So we have 4-hour chart here, the trend line going up, but look at the RSI. The trend is going down. So that's your divergence, and that gives you an indication that upward trend most likely will not hold. Okay, it's a lie. So then it came up to that trend, and then it fell way down below the oversold level. So that's how you want to take a look at or be aware of and familiar with what's happening when you see that bearish divergence. Definitely a weakness and a trend reversal there. And then let's look at, here's our bullish divergence, as you can see outlined in the graph next to you here. This is when the price has made lower lows, whereas the RSI is making higher highs in that same time frame. Now we have a trend line here, and this is gold. This is a 4-hour chart on gold. I find that both gold and oil 4-hour charts along with the RSI work really well hand in hand. This is a trend line going down, as you can definitely see very clearly, and whereas the RSI in that same time frame definitely going up. So, but then you're going, well, certainly it's going to continue to go up. No, it came back down below the 50, reversed back at that point in time, went above the 50, crossed the EMA, and then went through that trend line. And that's where then, because like you said, you want to use all of those in correlation with the trend line, your moving average, your RSI. You've seen there's a lot you can look at, but if you have your rules set, I'm not going to do this until that, or this needs to happen if that happens. So you want to be very specific in the rules and how you are using it at all times. So this was a good indication that trend, the lower trend, had reversed, at least for a very short period of time, and you can see then it came up and back down again. So that is your bullish divergence. Now, as promised, I was going to share with you the 3 biggest indicator mistakes that I've seen. And they're shown here on your graph, so you can certainly make note of them. So the first one is when you use the indicator to reinforce your current belief. You probably have heard said that you can't make the price happen. it's going to do what it's going to do. You have no control over it. And don't just look at an indicator and say, oh, well, I think it's going to do this, or I think it's going to do that, and use that alone and kind of make up your own story as to why you're going to use it. That never works when you use an indicator just to validate your belief rather than vice versa. Too many indicators. Number two, too many indicators leads to analysis paralysis. You've probably seen some people's screens that have all kinds of things going on, both on the price action chart as well as on their indicators. They have so many different levels of indicators. I use probably 3 or 4 of them at a time, and that, to me, that's certainly ample, but you will, try the different ones out and see which one works, obviously. But don't just get overloaded by it, and then you start second guessing everything you see. The third is when you rely solely, like I said, on one indicator. You don't want to do that either. You want to say, oh, well, this is this is oversold, so I'm going to sell, or this is overbought, so I'm overbought, so I'm going to sell, and oversold, so I'm going to buy. No, that doesn't work either. So please keep those mistakes in mind, and don't fall for them. Don't be fooled. Other than that, please trade with traction, not distraction. I would appreciate your comments, questions that you might have. And I appreciate your time. So please subscribe. Take good care. Thank you so very much.